And then there's this theory of a trial balance. And so a trial balance is what I just showed you over here. Is we make sure that our debits equal our credits. When you hear the word trial balance, it's just a fancy word for us saying, hey, does everything balance? We're trying out all of our journal entries to make sure they balance. And so it helps us find errors. So like I said on the first day of class, accounting's great if you want to get a perfect grade, right? Accounting, you know, you can find your own errors. This isn't chemistry. We're not searching for unknowns here. It always has to balance. And so we know if our debits don't equal our credits, we did something wrong. We know if our assets don't equal our liabilities plus equity, we did something wrong. And we can go back and check our work. That's why it was made the way it is. So if you have a mistake, you can go and make sure the trial balance is correct. If it isn't correct, you can check your account balances. You can check if debit or credits, maybe you did something wrong there. You can maybe you made a computation error. You can make sure that you posted it to the correct account or right journal, and verify that each journal entry has equal debits and credits. And so I'd be very meticulous and detail oriented when you're doing your homework, and make sure you have a cash account and make sure you're tracking, hey, journal transaction 1, we debited cash and then credited stock. And then make sure that you have both of those T accounts going on. And then transaction 2, maybe we credited cash, paid our employees. It's like a giant puzzle. Make sure you're keeping track of everything. And then we walk through the high level. How do we make our financial statements? You just take all of those journal entries and then you make your financial statements. Those financial statements, you're going to hear a lot of this is repetitive because I'm showing you the big themes, and I'm really trying to guide you to that big picture of here's journal entries, here's our transaction, journal entries, financial statements. And just remember that income statement, they're always prepared in this way. Income statement is going to show us our revenues and expenses. Statement of retained earnings is going to show how that income flows into our retained earning, flows into our equity. Then our equity is going to flow into our balance sheet, which shows us our accounting equation. And then our statement of cash flows is going to change us from GAAP accounting to cash-based accounting. And that's what this class is going to teach you, is how to make all of these financial statements, how to understand them, how to assess them. And then in this, they show an example of all these different transactions, what it would look like on your financial statements. Key takeaway here is why the order is important, right? Income statement, you calculate net income through revenue minus expenses. You need the net income to determine your equity, your retained earnings, because your retained earnings is your stock minus your dividends plus your income. And then you need your retained earnings to calculate your balance sheet, because that's part of your equity. And then you need your balance sheet in order to calculate your statement of cash flows. So it's this flow. There's some presentation matters, but I think you'll get the hang of it. The idea here is in this, this is something I hate about accounting, but it's just the way it is that we only put dollars at the first numbers and the last numbers. This idea, this bracket here, where we see this line, that means we're doing a sum. That means this 6,100 is the addition of these previous numbers. This double line means that this is done, that this is the final number for the statement. That means we're done with our math. This 6,100 minus the 2,705 equals our 3,395. So you can see this 6,100 is the sum based off these lines. So you can use the lines to kind of read where the numbers are coming from. Same thing on the balance sheet, right? 0 plus this is our 3,395 plus our 200 is our 3,195. Remember, we're always going to keep everything in dollars for this class. Foreign currency translations are pretty complex, but every financial statement is going to be in one currency. Also note that based on how big a company is, based on materiality, we might note numbers in millions or thousands, and you'll hear me do that in class. Instead of me saying 1,850, I might just say 2,000. We round to the higher numbers a lot of the time. And so you might see in some of your work that, hey, these numbers are reported in thousands. These numbers are reported in millions. Don't let that throw you off. And here's some more practice problems. So just make sure this is I gave the answers to you. I gave them to you so you can practice. Compute the debt ratio and describe its use. So here's something that's important, the ratios. So right now you're understanding every lecture, hopefully you're understanding a little more about what a liability is and what an asset is. But part of our job is then after we make financial statements is how do we then compare our company to other companies? How do we become good managers? How do we eventually become good executives? How do I get everyone in this class eventually making that six-figure income? You have to think analytically. And so to think analytically, we need to be able to compare information a lot of the time. We need to get good information and then be able to compare it. And how do we compare it? By making ratios. And so one of the ratios we can use, I'll be giving ratios all throughout the class, is this debt ratio. And so we can use this ratio to compare, let's say, Apple to Microsoft and see how much debt they have, even if they have very different sized companies. I can even compare Apple to LG or based on the ratio rather than the dollar values. And so our total liabilities divided by our total assets would be the debt ratio. So if the debt ratio is over 1, we have more liabilities than assets. Could that ever happen? No, it couldn't happen, right? Right? We can't have more liabilities than assets. Assets equals liabilities plus equity, right? So that's a trick. Make sure you know that. Evaluate the level of debt risk. A higher ratio indicates that there is a greater probability that the company will not be able to pay its debt. Right? If all of our liabilities are funded, all of our assets are funded by liabilities, we're probably in trouble, right? So you could be over leveraged. So total liabilities, total assets here. So 672, you can see the debt ratio and you can compare how it changes over time. You could also compare other companies. And then you could see, if this company has a 0.5 debt ratio, this company has a 0.3, this company might be using more liabilities. Is that a good thing? Maybe, maybe not. It depends on how the business is structured, why they have liabilities, etc. But memorize this formula. I'm going to give you, for every chapter, I'm going to give you a new formula to memorize related to ratios so you can compare companies. Okay, so that's this chapter. We went through it pretty quick. I'm going to make sure I have some time at the end to go through specific questions. But since this is an accelerated course, and because all of you are sharp and I want to respect all of your time, I'm going to really try to not spend too much time going over individual questions, but I'm going to spend our time here on theory and the quick ways to make sure you have it right. And then I'm going to make sure you have the resources to go practice those questions. And then I'm available, right? Your tutoring lab, you have all these other resources, your other students, and then you have my office hours to go over questions. And if we have a backlog of questions or a common trend, I'll make sure I bring it up in class. So what's your homework from here? I mean, other than your homework, what you need to do for this chapter, memorize these things, right? What are your asset accounts? What are your liability accounts? What are your equity accounts? Memorize those. Memorize your normal balances, especially right here. Expenses have a normal balance of a debit. Assets have a normal balance of a debit. Liabilities have a normal balance of a credit. Then bridge those two. Know that cash is an asset and has a normal balance of a debit. Understand how that ties into journal entries. Debits always equal credits. So practice some of the journal entries we have here, all the different transactions, as well as what I provided here and all the related videos. And then memorize that last piece, this debt equity ratio. If you have that, you're solid. That's all that is from this chapter. No, it's 66 slides. There's a lot of practice, but that's all I'm asking from you. Any other questions? Comments, concerns? Cool. Then we're going to go to the next one, and then we'll take a break after that. So the next one is chapter 3. This concept of adjusting entries, adjusting accounts.